Big surprise, the Federal Reserve just cut interest rates by 0.25%, which is the third cut this year after we saw similar moves in both September and October. So this is what we call a slow, gradual easing trend, not a big emergency slash of rates. But here's where it gets interesting. The vote inside the Fed was split. One member wanted a bigger, 0.5% cut, and the two of the members did not want any cut at all. That is the biggest disagreement that we've seen inside the Fed in years. So what does that mean for you and for mortgages? First, mortgage rates do not move in a straight line with the Fed fund rate. They follow whatever investors expect for inflation, the broader economy, not just what the Fed does in one meeting. Because it was widely expected, a lot of it was already priced into the bond market. That means that mortgage rates may not drop overnight just because the Fed moved by 0.25 point. In fact, we have seen in some recent cuts, mortgage rates have actually stayed flat or even ticked up a bit as the market reacts to the Fed's comments, not just the headlines, okay? Secondly, the outlook that the Fed gave for 2026 really matters right now. They're only projecting one more small cut next year, and members are still arguing. Some want no more cuts or even a possible hike. The Fed is not convinced that inflation has fully tamed. This means that you will likely see windows of opportunity where rates will dip and then bounce rather than on a smooth decline. If you'd like to hear more, please give me a call. Trisha Reese with Canopy Mortgage, the Bright Home Loan Team.